Hello everyone and welcome to this new episode of the DEA Member Spotlight series. This series is all about showcasing our members' innovations that are solving real challenges in the world of digital money, payments, and infrastructure. So if you enjoy this format, please hit like, share it with your network, and don't forget to subscribe to our channel to stay updated with more exclusive content. I'd like to start by thanking all our standard members for their continued support and say that at the end of the episode, we will open the floor for a few questions. So feel free to drop your questions in the YouTube chat box throughout the session. And now I'm pleased and honored to welcome today's guest, Lars Hupel, Chief Evangelist at D&D. And the discussion around programmable payments has been growing a lot in recent years. And when you look at the retail CBDCs, many central banks are still quite cautious about introducing programmable features. But at the same time, we know that the wholesale space programmability is often seen as something essential. And when we add stablecoins and tokenized deposits to the picture, the landscape becomes even more complex. So the key question is not simply whether payments should be programmable or not, but what level of programmability makes sense for different use cases. And in this session, Lars will help us to look at this topic in a more structured way. So instead of seeing programmability as one single concept, D&D proposes thinking about different levels of programmability. So Lars, thank you so much for being here, and I hand over to you.
Yeah, thank you very much for that introduction. And you're exactly right. We would like to go into a little bit more detail about what programmability means and different ways to achieve programmability. Now, I know that G&D and me especially are known in the CBDC context, but this talk is much more general. So Tamara, you got that really right. It's not just about CBDC here. It is about also other forms of digital payments. And there's even some mention of very traditional payment rails, the traditional deposit accounts in this presentation. So what do I want to talk about today? I have 3 points on the agenda. So first of all, I want to give a little bit of a historical context, programmability then and now, because I had a brief mention of programmability in a talk that I gave 3 years ago, and I want to show you one of those slides, and then we see what has changed since then. And then a second agenda point, I would like to define and explain what we understand under the name of smart contracts. And then the third point, I called it alternatives, but you can also call it characteristics or trade-offs or whatever. So I just want to embed smart contracts in a full hierarchy of different possibilities. So I'm going to show you a slide that I gave 3 years ago on the topic of retail CBDC and programmability. And I put some screenshots in there, and you see that the date of those screenshots is quite old. So there was a screenshot from 2023 news article, digital pound CBDC won't be programmable to avoid government control perceptions. Then there was an article from 2021, how dangerous is programmability? And then the third one is also quite old because Fabio Panetta is no longer with the ECB. At the time, he said that the digital euro will never be programmable. So this is just a historical excerpt on this. And as you probably imagine, the discussion has shifted quite a bit. On the retail side, there is still a lot of skepticism around programmability, but on the wholesale side, the discussion is very much different. But programmability is still a hot topic. So the Bank for International Settlements conducts an annual survey across multiple central banks, across emerging markets and advanced economies. And they often ask questions about digital assets, CBDC, also cryptocurrency, stablecoins, and around regulation. But they also ask about, for example, central banks if they're conducting currently CBDC experimentation. And they asked a question on retail CBDC features and they distinguish between programmable payments and programmable money. And here we see that around between 40 and 45%, so almost half of all central banks, both in the advanced economies and in the emerging and developing markets, consider programmable payments as a feature for their retail CBDC. But if you look at programmable money, first of all, it's much lower, but it's also very different across the different markets. So you see here the advanced economies are only around 10%. So that matches still what they said 3 years ago, like the Bank of England saying they don't want to do it. Um, and in the emerging markets, they are much higher there. So it's around 1/3 of central banks considering this feature. So I find that quite interesting, not just for the change in sentiment and also the more diverse or more nuanced discussion about the topic, but also that it's really still this distinction between programmable payments and programmable money. And I will pick this distinction up later again. All the while, good old cash is still in circulation, right? If you look at the numbers, the cash in circulation in Europe, for example, is still increasing. And also many other countries around the world. And there is no programmability in cash, right? It's just you can make a simple payment, you give it from one person to the other person. And that's also quite a beautiful model because you don't need to know much about the money. You know that you have a piece of money in your hand and that it's worth what it says on it. And you don't need to sort of figure out, well, if I give 20 euros to someone, can they use it for something else? Like, is it somehow conditional? You don't need to know that, right? So good old cash is kind of the baseline here. And I want to propose something else here. If you have ever been to a casino or have played some tabletop games, you know that there's often these chips, and those chips are kind of like cash in the sense that they are worth what they say on the face. So they have like 20 euro chips or $50 chips or whatever, but they're not really money in the sense that you can immediately use it for something else. You always need to go back to someone to kind of convert it back and forth. So, arguably there is some kind of programmability in this in this one, and this has also been around for many for a long time, right? So things that are kind of like money, but not entirely. Maybe there's some additional conditions attached. Um, and today, of course, most people will be using mobile banking, digital banking, and there it's even a little bit harder to understand, right? So cash, I mentioned, it's very easy to understand. For the poker chips or the casino chips, at least you have something in your hand, right? You can understand. But now with the digitization, we have more possibilities, but it also might be a little bit harder to understand how money actually moves around. And this is why we're proposing this framework just to understand a little bit better what's happening. I mean, even today, if you look at just a traditional bank account, there's a lot of things that you can do. For example, you can have direct debit orders, which is kind of some form of programmability, right? So I would allow a third party to debit money from my account when there's a payment upcoming, right? So it's also some kind of programmability coming up here. And if you have like cryptocurrency wallets, it can be arbitrarily fancy. Like you can set up whatever you want there pretty much. Okay, so with that little bit of historical context out of the way, I would like to dive a little bit deeper in the definition. So what are smart contracts? And it's quite interesting if you look at it, how the definitions have changed and where they came from. So I'm not sure if you have seen this person before. This is Nick Szabo. And Nick Szabo is a kind of an influential figure in the cryptocurrency world. And he gave this quote. So he said, a smart contract is a computerized transaction protocol that executes the term of a contract. And there's nothing about blockchain there. There's nothing about Ethereum there. There's nothing about DVP or atomic swaps. It's just a computerized transaction protocol. And the funny thing is about that quote is he said it in 1994. So 1994, that's the year when Microsoft stopped selling MS-DOS. So that's that's a long time ago, right? I was 4 years old. I didn't even attend elementary school, and he was already talking about smart contracts at the time. Um, and these days, I guess if you're like into Ethereum, if you're using Ethereum smart contracts, you would not really agree with that definition anymore. It's a little bit more specific now. So I propose, for the purpose of this presentation, I propose a slightly different definition. So I propose that a smart contract is immutable code, which is executed and whose data is kept wholly within the blockchain. So you have an underlying blockchain, and you have data on that blockchain. Data on the blockchain could be, for example, account balances, right? So I have 50 units of whatever money in my account, or I have some kind of credentials. I have some kind of private key, right? So that's sort of data that you can keep there. And then you have code that is deployed and executed and accesses this data and manipulates this data. And this notion really got popularized with Ethereum, right? So when Ethereum came out, it was the first major big application of smart contracts. Yeah, it came out in 2015. And one thing that was quite remarkable about it, that it had this account-based infrastructure, which is different than what Bitcoin did before. And it also popularized the term Web3, right? So the idea was that you suddenly have code that's not executed on someone's server of some social media company, but you have code that's executed worldwide in an equal way. So that was the whole idea behind it. And in Ethereum, the smart contract has a particular characteristics. So what is a smart contract in Ethereum? Well, it's a dedicated account with its own identity and balance, right? So a smart contract is not attached to a particular person, but it just has its identity of its own. It also has a life of its own. And once you create it, then it's just there. Like you cannot really delete a smart contract after you've created it. It may store any amount of data. So you can have certain values attached to that smart contract. You can have sort of account information in there. You can have public keys associated to the smart contract, or you can have pretty much any arbitrary variable that you can manage. You can store it in a smart contract. And it can also react to external inputs. So if I'm triggering a transaction, then the smart contract can react to that, and it can also trigger other smart contracts. So you can even have multiple, like you have a chain of different smart contracts that are interacting with each other. Smart contracts cannot access off-chain data. So in Ethereum, it's not possible to read information that's outside of Ethereum. You need to have an oracle for that, right? So you need to have an oracle that specifically reads off-chain data, feeds it into the smart contract, and then the smart contract can react to that, but the smart contract cannot do that by itself. It also has no ownership unless I specifically program it. So if I make a mistake, for example, and I forget to define myself as an admin to that, then I have no more control. I cannot kind of change it after the fact. So I need to make sure that I get it right when I deploy the smart contract. And this is also quite interesting because most code that's out there can be changed, but the smart contract, it's not so easy unless you have specific provisions in the code. And also, at least in Ethereum, smart contracts do not act by themselves. So if you're just deploying the smart contract, it's just sitting there. It doesn't do anything. It doesn't naturally spring into action. So you always have to call it yourself, or you have to tell someone else to call that smart contract. Now I know this is a little bit simplified, and there's many different blockchains out there that may have different ideas. There are some blockchains that have oracles directly built into the chain, for example. Um, and also there's lots of changes happening in Ethereum, but this is kind of the basic idea, which is sort of like, let's say 80% still accurate, or at least it gives you data. So the big takeaway message from it is the smart contract must be self-contained, right? So you need to put it on the ledger, and you need to give it all of the data, all of the code that it needs to run, and then you can interact with it at some point. Now, one of the most popular type of smart contracts that are out there is ERC20. So I'm sure you have heard of ERC20 before. It's a standard for tokens. Most popular, I guess, would be stablecoins that you can manage in ERC20. And how does it look like? Well, I told you that you can have pretty much arbitrary data that can be managed in a smart contract. And you can have a smart contract that says Alice owns 16 euro, well, 16 stablecoin euro, whatever. Bob has 9 euro and Carol has 22 euro. So you can have like a table of holdings by different people. And what does ERC20 allow you to do? Well, you can query the balance. So I can ask Alice, how much does Alice have currently? Well, not Alice, but like Alice's account number, right? So internally, it would be some kind of hash of an account. But just for purpose of presentation, I put a name in here. What else can you do? You can also ask for the total supply. So you can add all of the things together. That's still boring. What you can also do is you can transfer. So you can say, Alice, I want to transfer 5 euro to Bob. And that would be handled by the smart contract. And you can also have something that's called approve, which is kind of like the direct debit that I told you earlier as an analogy. So you can say, well, Carol is allowed to transfer from Bob's account at some point if she feels like it. Now, ERC20 only specifies the interface, right? So it specifies how the transfer and the approve should look like. It doesn't say what happens internally, right? So a particular implementation of ERC20 could also do things differently. So it could, for example, say, well, if it's a Monday, I'm not making the transaction for some reason. And you can also extend it, of course. So very often in these stablecoin contracts, you have not just the users, but you also have a vault where the freshly minted stablecoin is sitting before it's being distributed. And then, of course, you can mint, so you can increase the holding in the vault, but you can also freeze, right? Which is very important for compliance reasons. And like if some person is under sanctions, then the regulated stablecoin issuers will have to act on that. But they can also wipe, for example. So they could say, well, Bob, you currently don't have any money anymore. One of the other cool things about smart contracts is that you can have like composite smart contracts. So you can have smart contracts that interact with other smart contracts. And one of the things that typically are used is that the vault, which has like your 80 euros, is actually not just a single account, but it's like a multi-signature wallet. So you need multiple entities creating a signature in order to increase the vault or decrease the vault, right? So that's typically itself a smart contract that manages that. Or you could have, for example, Bob, who wants to buy something for the 9 euro, and he would lock that balance in a delivery versus payment contract, right? So he can commit these 9 euro that he has in that contract in some other contract. Of course, this is just a very, very rough overview. In reality, it's much more complex. I told you, for example, that smart contract code cannot be changed unless you make provisions for it. So if you look at all of the big stablecoin issuers like Circle or Tether, what they do is they don't actually have just one ERC20 contract, but they have multiple ERC20 contracts that are connected with each other. And when they want to make a change, they just swap out one of those contracts and update kind of the proxy contract that they have. So to some degree, they can make changes in that contract in case there is some problem somewhere in the implementation. But you need to provide for that when you write the code in the first time. When you don't provide for that, then you also cannot update it. Now, the term smart contract, I told you, has had some evolutions in the past and has some underwent some shifts in meaning. And I just want to finish the section off with a quote from this person. This is David Birch, and he wrote an article where he said that smart contracts are not smart and they're not contracts. So what does he mean by that? So they are not smart in the sense that they need to be pre-programmed, right? So and that they only react, they don't act. So a smart contract, for example, cannot act on the weather conditions because the smart contract doesn't know that, and it like you need to trigger it if something is going on, which is different from normal software, right? If you look at normal software, it can act by itself, right? So smart contracts don't do that. They only react to certain conditions. And the other thing is, and they're not contracts. What he means by that is they're not contracts in the legal sense, or at least it's a little bit of a dispute in the legal profession if they're actually binding contracts or not. And I'm not the lawyer, and I'm not a judge. My understanding is that for retail transactions, so for example, if I buy something in a shop, um, I cannot do that with a smart contract because, for example, in Europe, there are very strict definitions of how contracts should look like if consumers are involved. And the shop can't just tell me, oh, pay to the smart contract and it will work because, for example, the contract must be written in the local language, right? They should not be written in Solidity. They should be written in English or in German or in French. The story is, of course, very different when you have a wholesale business, when you do B2B or interbank payments and so on, because there they have a lot more flexibility in how they can set up um, their contracts. But you know, by and large, I think many of those questions are not yet answered. I don't think there's been many court cases about this. Someone has been sued because they did not follow the smart contract or something like that. But it's definitely something to keep in mind that this is not yet a fully settled question. Okay, so I want to talk a little bit about alternatives or possibilities if you want to. Because smart contracts, they are very powerful, but they also have a lot of problems. Imagine what happens if you have a bug in your smart contract. Imagine there's some coding problem, and maybe there's someone who exploits this coding problem and steals a lot of money. I didn't actually create a slide because you've probably heard of these cases many, many times, and this is not a talk about smart contracts being bad or something like that. That's not what I'm trying to say. I'm just trying to say that depending on the scenario, there may be better tools, and you need to look very closely at the use case, right? So one thing that I mentioned already, if you have a retail user or consumer that buys something, then maybe legally it's difficult to use a smart contract. But even in a B2B use case, maybe there are some disputes at some point, right? So maybe there are two banks that made a contract, a smart contract between each other, and they don't really agree how it was executed. Maybe they had different intentions when they went into that contract. If you do this on public Ethereum, well, you basically have very little recourse because the smart contract is the code and the code has been executed and the money has been shifted. So depending on what the situation is, you need some different approaches. And I'm a software engineer by profession. So I'm a big fan of this person. I have a lot of quotes in this presentation. So this is Tim Berners-Lee. Tim Berners-Lee, maybe you know him or have heard of him. He has invented the World Wide Web. So he's a very important figure in computer science. And he has already many, many decades ago, he has written about a concept that he calls the principle of least power. And what does it mean? It means that you should choose the least powerful language suitable for a given purpose. Now, what does it mean by that? What does he mean by that? In software engineering, there are many different programming languages, to achieve different goals, right? In the same way that you have different natural languages depending on whom you speak to, but there's also many different programming languages, and they have different levels of power, right? So there are some programming languages that are very powerful. You can express a lot of things with it, and there are some programming languages that are less powerful. And you can still do stuff with it. And depending on the use case, for example, if you're programming something on a phone, you need to be much more careful with your resources because the phone has limited resources than if you're programming something for a cloud environment where you have a lot more resources at hand. So there's different languages, and in the software engineering, basically you try to use the least powerful language that you can get away with for a given purpose. A way to explain this in simple English would be don't use a sledgehammer to crack a nut. If you want to crack a nut, use a nutcracker. Don't use a big sledgehammer. And we can apply the same principles for programmability. And I want to give here the proposed hierarchy. So if you take away only one thing from this presentation, then it would be this slide, I guess. The lowest level in this hierarchy would be no programmability whatsoever, right? So this is the cache example that I explained to you. In cache, you cannot automate anything. You cannot attach any conditions to anything, right? The only thing that you can do is you can make a simple payment from A to B. You know how much money you have. Uh, you know that you can spend it for any purpose that you like, and the receiver can also use this money for something else. So in Ethereum terms, it would be fungible. So you have perfect fungibility because it doesn't matter which €5 banknote you have or which €1 coin you have. It's always the same, right? It doesn't even matter if I have two $10 bills or one $20 bill. It's all the same thing. It's perfectly fungible. Um, if you compare, on the other hand, for example, when you have one circle dollar and one tether dollar, they are not perfectly fungible, right? Because there might be slight differences in pricing and so on. So you already, like, if you leave this field of cash, you already get some slight deviations from this fungibility. But if you have cash, perfect fungibility, no problem. The next layer in this hierarchy would be programmable payments. And programmable payments are systems where you can trigger stuff based on certain conditions. So, for example, when you can set up a standing order, right? So you set up in your bank account every week or every month, I want to pay pocket money to my child. That is already some form of programmability. Why? Because in most circumstances, the banks will give me the possibility to set up these kinds of things, right? So the bank needs to provide for that, and in most cases, banks will provide some form of that. Um, there are banks that allow to do a lot of things with programmability, so with APIs, and there are banks who don't do a lot of that. If you're a corporate, you will have typically full-blown APIs that allow you to do liquidity management and monitoring incoming and outgoing payments and scheduling payments and optimizing your working capital and all of these things, which I typically don't do as a consumer. As a consumer, I just have my normal bank account and there's maybe some 3 incoming and 3 outgoing payments a day. And I can set some dates and schedules, but that's pretty much it. But this is very flexible. And many countries have started mandating more open access, which is typically called open banking, that third-party providers can do stuff in my bank account on my behalf. And I have some examples for that at a later point. But still, there's no blockchain, there's no ledger here. It's just very simple programming, right? So you have a bank and they offer you an API, and then through that API, you can trigger certain actions. Then the next level would be programmable money. So programmable money is the level where you can have certain conditions attached to the money itself, right? So one example that I would bring here is specific individual stablecoins. So I would call Circle dollars or Tether dollars or whatever euros you have, I would call them programmable because the issuer can do certain stuff with that money, and I can also do certain stuff with that money. So as soon as I'm able to attach certain conditions to the money itself, then I would call that programmable money. I would also call the casino chips programmable money. Why? Because they're not perfectly fungible. In order to do something with them, I need to change them back, right? I need to no one else will accept the casino chip except for the casino. So if I won a lot of money in the casino and then I want to celebrate and drink a beer, I need to go to the cash desk and I need to exchange the casino chip back for cash, and then I can kind of make a payment. But the definition is not always completely 100%. Yeah, it's a bit of a gray area also between programmable money and programmable payments. And then the final layer would be full smart contracts. So if I have a full-blown programming language, that would be, if you ask Tim Berners-Lee, that would be the full power that you can do everything, and you can automate a lot of things. And that's sort of the upper end of the spectrum. And most use cases fall in between, right? You very rarely have use cases that can be done with no programmability, right? So except if you have a simple payment, right? Um, for example, you can't do direct debit with cash. Like I cannot just go to your place and take money out of your wallet. I mean, I could, but that would be stealing. So, and there's also very few use cases that really require full smart contracts. And this is exactly that gray area, like this trade-offs and this in between that I want to explore a little bit in this presentation. Because very often when we talk about programmability, and also as Tamara mentioned in the introduction, when you talk about wholesale, everyone thinks, oh, clearly you need smart contracts. Clearly you will solve that with smart contracts. And I mean, you can, of course, you can solve many problems with smart contracts, but maybe sometimes you don't even have to. And to make this a little bit more concrete, I have here a simple diagram of how a normal payment works, right? So let's take a look at how today money moves between two bank accounts, right? So I'm the sender, I have a bank, and the receiver of that payment has possibly a different bank, and in the middle there's the central bank that operates the system and that is responsible for the settlement. So what happens if I make a simple payment? Well, first of all, I tell my bank, and then my bank will debit my account. So they debit 10 euros from my account. Then there's some kind of routing happening. So bank A finds bank B, and bank A tells bank B, I want to send you 10 euros, and please credit that to your person. I have just debited it from my customer. And the central bank will do some kind of interbank settlement at some point, and then you credit this at the end. And somehow, even though this is not on a ledger, and even though this is not on a smart contracts, somehow this happens atomically, right? If you have ever used instant payments, which is now possible in Europe for a long time, and it's also now mandatory in Europe for banks to offer, but also in other countries, all of this sort of happens in a coordinated fashion, right? So there's obviously a lot of code, a lot of contracts executing here, but there's not really a smart contract anywhere to be seen. And many of those errors that you see here are quite complex and can be used to add in additional conditions. And one of the ways that you can do that was with the project Meridian by the BIS Innovation Hub. It came out already a few years ago. And they thought, well, now when you're buying a house, you have to make a payment, right? You're paying from the buyer has to pay like, I don't know, 100,000 pounds to the seller. So you can make this a simple transaction. However, what if the seller don't actually give you the house, right? Then you have paid the money, and this is all automatic and it's fast and whatever. UK also has an instant payment system. But I kind of want to ensure that the house actually belongs to me when I make the payment. So what they said is the following. Well, they say, we will not touch the actual payment. The payment works. We know how we know how to make a big payment from bank A to bank B. It's a solved problem. What we don't have is a way to synchronize this operation with the actual house sale, right? So there's a land registry. The land registry has some information about who owns a house, and you want to connect those two things together. You want to synchronize the actual payment with the update of the house. Now, in a smart contract world, in Ethereum, what you would need to do is you would need to put the money on the ledger and you would need to put the house on the ledger. So you need to put everything on the chain, or maybe you need to do it on two chains and use a bridge, whatever. But the idea in the smart contract world is you just put all of that on chain, basically. But that it's not always realistic. It's not really realistic from one day to the next to have all of these things on chain, like the land registry and all of the bank accounts and so on. Maybe at some point in 10 years, but for now they thought we should try to achieve it with the traditional technologies, and they achieved it with the traditional technologies. So what they did is they introduced something that they call a synchronization operator. And the synchronization operator is kind of, you could call it a technical service provider. It sits in the middle of the transaction. And let's now walk through this house sale one by one. How does it work? So first of all, the synchronization operator performs a balance check on both banks. So they check if the buyer has enough funds to actually make the payment, and they also do that with the seller because the seller may have some outstanding mortgages and needs to check if the mortgage can be paid off when you do the house sale. It's like you have a lot of different checks involved when you're buying a house. And then what they do, once all of these checks have been completed, they will go to the land registry and they will earmark the asset. So they will make a little note in the land registry saying, well, this house is not going to be sold. We are locking it. No one else will touch it, right? So this is what they mean with earmarking. So they're not actually transferring the asset yet. They're just making a note saying, this house is currently in progress. We're doing something with it. Please, keep it safe for now. And then in the third step, it also earmarks the amount. So it tells to the RTGS, it goes to the Bank of England's RTGS and says, you know what? Please reserve 100,000 pounds in the account and we will finish the payment later. So what happens after this step 3 is you now have the asset and you have the amount, and they're locked and they're ready to be transferred. And if something would went wrong, you could just undo all of these steps. No money has moved, no house has moved. But the synchronization operator has ensured that all of the necessary precautions have been completed. And then in the last step, you do the settlement. Actually, I forgot to put also the settlement in the land registry. You don't just settle the money, but you settle also the house. And the interesting bit here is that you have lots of traditional technology. You have a land registry that's perhaps some kind of very old database, maybe written in COBOL, running on a mainframe, I don't know. And then you have slightly more modern RTGS and bank systems, and you can connect them together. And all you need is the synchronization operator that will kind of orchestrate this operation. And if you read the original paper from the BIS, it's quite fascinating because they do also synchronization for multi-step house sales. So in UK, what happens quite frequently is that you have people who buy a house from someone else, and then that someone else is also buying a new house, like a bigger house. So you have these multiple swaps of houses, and they manage to synchronize all of that in kind of a single transaction or in like a single bracket that they put around the transaction. So it's quite fascinating that they managed to do that. Of course, as I mentioned before, in the future, maybe some of this will be on-chain, but for now, they managed to do all of this off-chain using traditional API connections, and they didn't have to change a lot in those existing systems. They had to add this earmark functionality. Some of the systems already supported this earmark functionality. If you're into that sort of thing, if you like ISO 222 and that stuff, go read the paper. It's quite fascinating. But basically what they did is they implemented the delivery versus payment, right? So a more simple case would be I buy something from an online shop and they send me the parcel, and then that moment the payment gets released. So of course, a house sale is a little bit more high stakes, right? It's not just it's not just a phone that I order. I would order I order a phone every few years. I don't order a house every few years. But the general idea is that you take a look at this existing payment flow, and then you just identify the necessary steps where you need to maybe hold a payment or earmark a payment, and then you can complete it after all of the necessary steps have been done. But of course, there's other examples out there that can be done also without smart contracts. And the first example that I want to talk about is a wholesale use case, which is security settlement. So let's say you have two banks that want to make a loan. And one of the ways that they can do that is using a repurchase agreement, a repo. And the repo works by one bank giving another bank a security, like a government bond, and then the other bank giving money, and then the next day they reverse it. So they would shift it around again. And one of the problems with repo is that if those two steps are disconnected, it might be the case that one bank gives the government bond to the other bank, but the other bank never pays back. So that's a problem that could happen. And of course, banks don't like that. They call that a risk and they want to avoid that risk. So some countries have started connecting their security settlement systems with their cash settlement systems. In Europe, this is called T2S, Target to Securities, and you can connect the securities transfer with the actual cash transfer. And the system works for many countries in the Eurozone, all of the countries that are connected to this T2S. And that way you can have these kind of atomic DVP going on there. I'm not aware of anything for the consumer level yet. So if I'm a consumer and I want to buy a stock or something like that, I don't think this is currently possible. This is only for wholesale use case. Next wholesale use case would be foreign exchange. So two banks trading like USD and Euro with each other, and the story is kind of the same, right? The story is the same, like, what if I give USD but I don't receive the Euro back? And now the challenge is that you cannot just have one central bank running the system because, it's multiple currencies. You have multiple central banks that are involved in that. And maybe they have different systems, maybe they have different operating hours, so it would be quite challenging to do that on that level. So one of the ways that this can be done, at least for major currencies, is using CLS Bank. So CLS Bank is a special bank in the US, and they do that sort of atomic settlement of different currencies. So you can call CLS Bank and say, I'm Deutsche Bank, and this is I don't know, JP Morgan, and we want to trade USD for euro, and then this would be handled by CLS in a similar way, using the synchronization approach. Now, CLS is not perfect because you cannot trade all of the currencies here, and still have operating hours. So the BIS has also investigated if you can do this more efficiently with a smart contract. And the answer is potentially yes, you can do this more efficiently with a smart contract because you can have more currencies, you can do it 24/7. And one of the main things also is that you have more providers of liquidity that could be connected to this. So here, this is a use case that currently works, sort of, but potentially it can be improved if you use not just programmable payments, but potentially if you use smart contracts. And the last use case I find very, very interesting. It's a once more retail use case. And I found it in a paper that's only a few years old. I'm not sure if you have heard of Monzo. Monzo is a bank, one of the modern mobile first banks. I think they first started working in the UK. And Monzo has kind of pockets. So you have your account, let's say you have £1,000 in your bank account, and then you can have pockets for specific purposes, like you want to have a holiday pocket. So every month you put £5 or £10 in your holiday pocket. Or maybe you have I don't know, food pocket or whatever. So it basically allows users to understand what they're using their money for. So classic personal finance use case. And Monzo has provided an integration with another tool that's called If This Then That. And in If This Then That, you can set up automations based on some triggers that you can do using your phone. And one of the things that they describe in the paper was if your phone detects that you are in the gym and you're working out and you're in the gym for 1 hour and you're working out, uh, then you can automatically transfer £5 into your holiday pocket or something like that. So kind of a reward system. You can reward yourself. If your phone detects that you're in the gym, you get something. I don't know if they also have the opposite. Like if your phone detects that you have not been to the gym for a week, maybe it deducts something from the pocket. I don't know. But it's kind of an interesting idea because it all can be set up by users. And it does not require any programming knowledge. You don't need to know how Solidity works. You don't need to know how Java works or whatever. You just have a few buttons that you press in the app. You say, if this condition is triggered, then, move money from here to there. So they managed to do this also completely without the smart contract capability. And I'm sure you could do that with smart contracts also, but the beauty of this use case was that you don't need to know any programming, right? It's completely accessible, and pretty much everyone who has a bank account will be able to understand what's going on. And I think that's fairly beautiful, because it could create a lot of innovation. It could create a lot of use cases on that. And I just wish that my bank would have the same integration, to be honest, because my bank doesn't offer these kind of pockets. They don't offer this sort of API to other services, because then I would probably go crazy and have many different convoluted rules of how I want to save my money for different purposes. Maybe for me it would be cycling. If I cycle more than 5 kilometers, then I get €5 for candy or something like that. I don't know. So you can come up with many different ideas. And another thing that I just wanted to mention here is also quite good on privacy, because the bank does not actually get to know why you're doing this shift, right? So the bank does not know anything about the rules that you're setting up. That's just your thing. And the bank, they just received the payment instruction at some point. They just received the instruction, put £5 into this pocket, but they never know why. which is also different in a smart contract. In a smart contract, the code is always transparent. Like you can look at a blockchain, you can look at Etherscan, and you can read the code and you understand why this has happened, which is, probably not great if you're doing this kind of personal finance stuff. It should not you should not be able to see why you're doing this whole thing. Okay, so this is actually my last content slide. I only have one conclusion for you, and I hope this is what you take away from this presentation, and I'll keep it short. Use the right tool for the right job. There's a lot of things that you can do with smart contracts, but there's also a lot of things that you can do without smart contracts. And when you're designing these use cases, when you're designing these payment systems, it's kind of interesting to see, um, you know, what is actually needed. Like, do you have a trusted party, for example, in the system? Do you have a party that coordinates all of that thing? Then maybe you can do it with plain APIs, right? But maybe you don't have that. Maybe you have 5 different central banks that need to connect to each other and need to, do the foreign exchange use case. Then maybe you have to use a smart contract because then it's the only tool that can satisfy that job. And with that, I am concluding my presentation, and I'm sure you have a lot of questions, which I'm happy to answer now.
Amazing. Thanks a lot, Lars. Really insightful presentation. Yeah, perhaps we can start with some warm-up questions. So you mentioned how the concepts have changed
Yeah.
during the time. What is one misconception you heard most often when people talk about programmability?
Yeah, I think the biggest misconception is that programmability is equal to smart contracts, or that you need smart contracts to have programmability. Um, and another, well, I wouldn't call it a misconception, but I still remember the time when people said wholesale CBDC, we don't need it, we have RTGS already. And that was a misconception. And now people say, in order to do wholesale CBDC, you must do smart contracts. And this is also a misconception. So, so it's kind of interesting to see how these perceptions are shifting over time. And once again, I'm not really saying here that smart contracts are bad or that they shouldn't use them. What I'm saying is that we need to really look very carefully at the different use cases, and maybe sometimes the correct tool to implement it will be a little bit surprising.
Yeah. Yeah, we have a question here about industry. So, yeah, have you seen any promising use case of programmability outside of the financial industry?
Yeah.
So maybe, yeah, which industries do you think will benefit first
Yeah.
from programmability?
Oh yeah, that's a very good question, because we've had these conversations also a lot. And I want to first give a negative example, and then I will give a positive example. So, when you do international trade, a lot of the time the problem that you have is that you have to wait for a long time for the money to arrive, right? So, for example, the buyer will have 30 days to pay, and then the buyer pays after 30 days, and then takes 5 days to go through the correspondent banking system and so on, especially if you're trading like, let's say, two currencies that are not so big in the market. Then you have to go first to USD and then so on. So, some people have proposed, well, you know, instead of just paying normally, why don't we put the money into an escrow account, right? We can have set up a smart contract, and we can put the money into the escrow account, and then after 30 days, the payment will get released from the escrow account to the seller. And I'm saying this is a negative example because the question is, why would the buyer do that? I mean, the buyer doesn't want to pay now. The buyer does not want to put that money into the escrow account now. Why would the buyer do that? Right? So the buyer actually likes that it doesn't have to pay until 30 days. Of course, it could be like the 5 days could be faster, right? I mean, that's not the fault of the buyer. But the escrow account use case, I always found a little bit dubious, because there's a reason why payments have to be done only after 30 days instead of instantly. So it's a question about working capital and so on. So this is a use case where I'm a little bit skeptical. But in the same domain, like if we stay with this cross-border international trade, there's also potential positive use cases in that area. You just have to think a little bit harder. We've been reviewing also the literature on this and looking what like the academic literature has come up with. And one of the use case that I like is same thing. You have a buyer and a seller of goods, and maybe the seller is a small company, right? So maybe you're ordering 1 million screwdrivers or something like that. And the company, the seller that manufactures the screwdrivers doesn't have all the money that they need to make this. But what they can do is they can sort of take the order and tokenize it and get the loan against that order, right? And then they can get some fresh capital and they can produce the 1 million screwdrivers and they can deliver the 1 million screwdrivers. And in case there's a problem, you still have the order and you can get a loan against that, right? So there's kind of a guarantee, and you could even potentially trade that. You could say, well, um, I'm giving this kind of order token to someone else, and then maybe someone else does half of that order, satisfies half of that order, something like that. We have tested that out in a use case between Ghana and Singapore, where you have these sort of like trade tokens that allow you to finance much easier, right? So that way you can empower smaller businesses to take on bigger orders, which will eventually be good for the economy. But this is very early stage, right? Unfortunately, we don't have a fully working solution for that, but it's also been proposed, for example, the BIS in, I think it was called Project Dynamo, if I'm not mistaken, that you have this use case not about the actual payment, but about the financing of the operation. So in that case, I think international trade might benefit from that. Yeah, that was a very long answer to that question, but I hope it answers the question.
Yeah, no worries. I really like this slide that you showed all different levels of programmability. And you said that most use cases are in the middle, right? In this
Yeah.
gray zone between different levels. So where do you think most real world use cases will actually land in the next 5 years? Do you see any changes for any direction? So more programmability or less programmability?
I guess it depends also a little bit on the payment instrument that you're using, right? So then we're back at the discussion of, are we using CBDC or not? Because in at least in retail CBDC, I don't foresee any big shifts. I showed the slide initially. There's still much more demand on programmable payments. Some central banks have now started using conditional payments because they think programmability itself is has a bad connotation with it, has a bad smell. So they're using conditional payments instead. If you're talking, for example, about tokenized deposits, it's at a completely different side, right? I mean, for tokenized deposits, there's a lot of use cases being presented about full smart contracts and so on. When you have, I don't know, machines paying each other or something like that. So I think the question should be in a different direction, right? You have different instruments, and then those different instruments enable different use cases, and then you just pick the instrument that works best, and then you work with the capabilities that the instrument has. And you say, if you're dealing with consumers, you use retail CBDC, and then you get the conditional payments. If you're working B2B, then you use maybe tokenized deposits, and then you get the full smart contract capabilities. Maybe if you're between banks, then maybe you use a wholesale CBDC and then has yet another approach. Or maybe you want to do completely anonymous payments with stablecoins, then you have the full ERC20 support. So I think the differentiation will come probably from the different instruments that will be available or are available already today.
Yeah, so a different mix of different solutions for
Yeah,
different problems.
I
Yeah,
mean, I guess this is also a broader point because I mean, I've heard over the past years a lot of excitement about like, let's put everything on the same ledger. And
yeah,
I don't think this will ever happen, putting everything on the same ledger. So you will have to live with that sort of fragmentation. And then you just need to be a bit more careful about choosing the right ledger or choosing the right instrument. And then you have to build bridges between them. I think this is inevitable. We need to prepare for that, and we need to be able to cope with different instruments having to talk to each other. You need to be able to convert stablecoin to wholesale to retail, and so on. All of this will have to be necessary. And not because we're too stupid, but because it's just unrealistic to get everything on the same instrument, on the same ledger. I think it's just not happening.
Yeah, and looking for this preparation, right? If a central bank or a financial institution wanted to start experimenting with programmable payments or programmability in general, what would be the first practical step for this?
Provide open APIs, to be honest. So what Monzo did, for example, opening up their system so that third-party services can interact with it and can trigger payments and can make some instructions on users' behalf. I think this will already allow a lot of experimentation, and it's relatively low risk because it will be constrained and like there's not a lot of things that could go wrong. For starters, you could also have APIs that allow you to do analytics. So one example on that is if you have a stock brokerage account, if you're like investing in ETFs, for example, there are some apps that can read out that information and give you analytics. Can tell you, oh, this is the performance of your portfolio or something like that. So that already gives you insights. And then it can tell you, okay, so next month you maybe should shift from here to there because now suddenly you have more stocks than bonds and you wanted more bonds than stocks and whatever, so it can do these sorts of things for you. And that's relatively low risk, but you can already imagine a million different use cases that you can do with that. So my appeal would be start providing those APIs and start opening up those systems, start breaking up those silos, because APIs are everywhere in the world and they drive a lot of software. Just in finance, we haven't really caught up with that yet. Like many systems are very closed and you have no access from the outside. And I think this is one of the biggest pain points in the industry right now, that many systems are so siloed and they don't really talk to each other. And we can already break up those silos and enable a lot of things by just having APIs.
Great. Yeah, we do have time for more one question. Yeah, you mentioned many examples, the buying a house, the security settlement, the foreign exchange, also the personal finance, the really fun one with the rewards. But if you had to pick one use case that will really demonstrate the value of programmability, which one would be?
Huh. Oh, that's a good question. I have to pick a favorite.
Yeah.
I think for the wholesale market, the DVP and PVP is probably the biggest game changer, because in the wholesale market, this is a lot of there's a lot of pain waiting for multiple days to do the settlement. It's not entirely trivial to do that. Like there's like if you tell banks, oh, tomorrow everything is DVP, they will say, oh, we need a few years to implement all of that. So, but I think in terms of volume, like if you just look at the amount of euros or the amount of dollars, then probably the DVP and the PVP is the biggest thing. If you look at the retail business for consumers, I honestly don't know. I think time will tell. I mean, and the private sector will have to come up with some new use cases and some new innovative ideas, and then see how many people are using it.
Yeah, good point. Yeah, thanks a lot, Lars, once again for this yeah, fascinating discussion. And before we wrap up, yeah, please give your final thoughts, closing remarks.
Yeah, I can only repeat it. Use the right tool for the right job. And thanks for listening today.
Thank you. Thank you so much, Lars. And a big thank you as well to everyone watching and engaging with us today. If you enjoyed this episode, please like the video, share it with your network, and subscribe to our channel to support this initiative and never miss a future episode. We see you soon for the next episode of the DEA Member Spotlight series. Until then, stay curious and stay connected. Thanks a lot.